Stablecoins and tokenized real-world assets are no longer just crypto experiments. They are becoming rails for payments, settlement, treasury, and capital markets. In this topic, we'll look at what makes them scalable, trusted, and ready for institutional use. So far, we've focused on the core regulatory problem. Unclear rules create uncertainty around token classification, exchanges, custody, disclosures, and institutional participation. Now we turn to what those rules are trying to govern: stablecoins and real-world assets as financial infrastructure. This sets up the legislative frameworks we'll examine next. The early digital asset market was mostly about exposure, trading, speculation, and alternative investment narratives. Stablecoins changed that role by adding a cash-like instrument that moves quickly, settles continuously, and supports liquidity across markets. RWAs extend the idea by bringing traditional assets such as treasuries, funds, credit, real estate, and commodities onto programmable rails. Together, they are more than new products. They are building blocks for payments, settlement, ownership, collateral, and distribution workflows that institutions can build around. Stablecoins are digital tokens designed to hold a steady value, usually $1. That makes them useful as settlement assets. Money can move between exchanges, wallets, payment apps, and decentralized applications without waiting for traditional banking rails. Their appeal is speed, around-the-clock availability, and programmability. For institutions, though, usefulness depends on trust. Strong reserves, clear redemption rights, reliable controls, and legal certainty. A major reason stablecoins became so important is that they act as a liquidity layer. Market participants can hold and move a dollar-like asset without constantly returning to banks. A trader can sell Bitcoin into a stablecoin, pause, and redeploy into another asset within minutes. Exchanges can also quote many markets against the same stablecoin, improving price discovery and global access. The advantage is availability. Crypto markets run continuously, while bank transfers may be slow, regional, or closed. As stablecoins support more activity, regulators focus more closely on reserves, redemption reliability, and systemic importance. Cross-border payments show the trade-offs clearly. In the traditional model, money may pass through correspondent banks, foreign exchange steps, and multiple compliance checks, adding cost and delay. With a stablecoin flow, dollar-denominated value can move across a blockchain almost immediately, then be converted by a local payout partner into cash, bank deposits, or mobile money. That can improve remittances, supplier payments, freelancer payouts, and platform disbursements. Still, the model depends on reliable ramps, AML controls, sanction screening, licensing, and consumer protections. One practical way to view stablecoins is as a settlement layer inside the payment stack. A customer may still pay with a card, bank transfer, or local wallet. Behind the scenes, a platform can convert value into a stablecoin for faster cross-border movement, then pay the merchant in local currency or stablecoin. For marketplaces and fintechs, this can improve payout speed, treasury management, and programmable transfers. But the business case is not automatic. Teams still need to compare costs, settlement risk, chargebacks, accounting treatment, and regulatory permissions before deciding whether stablecoins improve the existing payment flow. For corporate treasurers, stablecoins are not only a payment tool. They are a liquidity rail for moving value between subsidiaries, platforms, custodians, and counterparties at any time. That can reduce settlement delays, idle cash, and manual payment steps. But treasury use has to be governed like any critical financial infrastructure. Teams need approved issuers, secure custody, clear wallet ownership, transaction limits, sanction screening, and redemption procedures. They also need plans for depegging, issuer failure, fraud, accounting treatment, and audit evidence. The operating question is simple: can the business move faster without losing control? Real-world assets are usually not brand new assets created by crypto. They are existing claims, such as treasuries, real estate, commodities, private credit, invoices, or fund interests represented in token form. The bridge is the legal or contractual wrapper. It defines who owns what cash flows they receive, and what happens if something goes wrong. The blockchain token then becomes a digital handle for transferring and settling that claim. Tokenization can make distribution faster and more transparent, but the key question is always, What rights does the token enforce? Tokenized treasuries and money market funds are often the first RWA products institutions understand because the underlying assets are familiar: short-duration government securities or regulated cash management funds. The token is not usually the treasury bill itself. It represents an interest in a fund, trust, or account structure that holds the assets through custodians and transfer agents. That structure matters. It determines ownership, transfer permissions, and required disclosures. Institutions use these instruments for yield-bearing cash, collateral, settlement balances, and as building blocks for on-chain finance. As tokenization moves beyond cash-like and publicly traded assets, the opportunity expands. But so does the operating burden. Private credit can make loan participation, servicing, reporting, and investor distribution more efficient. Real estate tokens might represent equity, debt, revenue rights, or fund interests linked to properties. Commodities and invoices connect tokenization to trade finance, collateral, and supply chain funding. The key mental model is this: the less liquid and more bespoke the asset, the more diligence matters. Valuation, legal enforceability, transfer limits, jurisdiction, and investor suitability become core design choices, not afterthoughts. When fund interests are tokenized, the token becomes part of the fund operating model. Investors still need onboarding, KYC, eligibility checks, and subscription documents. But once those controls are connected to issuance, servicing can become faster and more consistent. Transfers, redemptions, investor notices, and cap table updates can move through controlled workflows instead of disconnected manual processes. The critical constraint is alignment. The token must match the fund documents, transfer agent records, exemption relied on, and each relevant jurisdiction. Efficiency only works when the legal and operational records stay synchronized. Institutions do not adopt stablecoins just because the technology works. They need a chain of trust. Reserves must be high quality, liquid, and clearly tied to redemption rights. Custody rules must separate customer assets and reduce bankruptcy risk. Oversight adds supervision, audits, disclosures, and reporting, so boards can approve usage with confidence. AML, sanctions, and consumer protection controls determine whether a stablecoin can plug into regulated payment systems. In this context, regulation turns a token from an interesting tool into infrastructure institutions can actually use. For RWAs, regulation is not just a barrier to adoption. It is the operating system that makes adoption possible. Before a tokenized asset can scale, participants need clear rules. Who is allowed to invest? What information must be disclosed? How transfers are controlled? And who is responsible for custody and records? Without those controls, tokens may move faster than legal rights can follow. That is unacceptable for institutions. The goal is to connect blockchain efficiency with enforceable investor protections, compliant transfers, and reliable governance across the full asset lifecycle. Stablecoins are becoming payment and settlement rails, while RWAs bring traditional claims like treasuries, credit, real estate, and fund interests onto tokenized networks. But adoption is not just technical. It depends on rules for reserves, custody, disclosures, transfers, eligibility, and oversight. Next, we connect these use cases to US legislative frameworks: Clarity, Genius, and Stable.